at least for now, it seems like if you look at the US reaction to the Hong Kong, the national security law, in my opinion, the reaction from the US has been fairly measured, right? Even though they have banned Hong Kong to import the sensitive technology from the US, but to me, that's just one of the low-hanging fruits in terms of the special treatment that Hong Kong can receive from the US government. So they haven't really targeted like the customs duty. They haven't really targeted Hong Kong's ability to convert the US dollar. I mean, those are, to me, is a high-hanging fruits, which is a bit difficult to touch at the moment. That's why I think the US reaction, in my opinion, is fairly measured. I mean, that's why I can understand the market has been really, chaired all those muted reaction. But of course, in the medium term, 3 months down, 6 months down the road, I think there's a risk we cannot ignore. And also we need to monitor whether we are going to see the Democrat sweep. So which may potentially also cause some kind of the volatility in the US equity market, which in turn may cause the volatility in China's equity market as well.
Right. Tommy, talking about China assets, you prefer China equities versus bonds, and you're not the only one on this call, because yesterday we had another guest highlight the same preference. I want to understand, why is that the case? Why is it that China equities are looking more attractive than bonds, given how little the PBOC has done in terms of lowering rates? I would have thought that the yield on fixed income in China would look fairly attractive.
Right. I think overall, I mean, for the 10-year government bond at 3%, that's really attractive in my opinion. But the problem is that just now, as I mentioned, when we look at the China's monetary policy, for example, well, usually we talk about the easy credit and easy money. So that's a very unique feature for China. So what PBOC has been trying right now, so it seems like they prefer the easy credit versus easy money. So if we look at the historical pattern, whenever we have the easy credit, it's good for the equity, but may not be necessarily good for the bond, unless we are going to enter this, we call the easy money kind of the situation. So which means we are trying to see the PBOC to lower the interbank market, to inject the liquidity into the interbank market. But that seems like not the key direction from the central bank perspective. So their direction is still how can we put the money in the hands of the company directly? How can we lower the funding costs to the company directly? So in other words, it seems like the role of the banks or the role of the money market become a little bit lesser as compared to the usual time. So that's why it seems like one of the challenges right now for a lot of bond investors. They still need to adjust for this kind of the new normal, which is the easing credit is the dominant theme right now. That's why I think it seems like the equity market may outperform bond market in the near term under this easing money mentality.